Hi, everybody. This is Alan Elman, the Blue Collar Investor, welcoming you to another one of my sample Allen trade videos. This one with Howmet Aerospace Inc. listed on the New York Stock Exchange under the ticker symbol HWM. This is a trade that I initiated on Monday, May 5th, 2025, and expires on May 16th, 2025. So it's a 12-day covered call writing trade. Now, over the past couple of months, I've been telling you that I've been doing mostly defensive trades, in the money covered calls and out of the money or deep out of the money cash secured puts. And I also told you that a small portion of my portfolio was still dedicated to more aggressive trades. Well, many of you have written to me saying, could we see an example of one of those aggressive trades? So that is why I created this video. This is an aggressive covered call writing trade I initiated just a few days ago. Again, today is Thursday, May 8th, and it's about 11 a.m. Eastern Time. Okay, so why did I choose Howmet? Well, here's an image of a small portion of the BCI Premium Member Stock Report, which we produce weekly for our premium members. I highlighted the Howmet row in yellow, and you could see that it came from where it says other, that means it came from the BCI database, not from an IBD resource. And we've identified over the past 18 years, many securities that are potential covered call writing and cash secured put candidates. Now, you can see here that it's in the aerospace industry segment, which is currently ranked A, was also ranked A last week. Now, if we look at the mean analyst rating, it's 1.66, which is excellent, since the ranking is 1 the best and 5 the worst. So it's an excellent MAR. Now, the on-balance volume has an up arrow, which means more cash is flowing into this security on up days and on down days, another bullish signal. Now, moving over here, we see that there is actually a small dividend yield of 0.3%, and the ex-dividend date is 5/9, which is in this contract. So if it was absolutely critical to you that you don't lose these shares by exercise, well, you probably wouldn't execute this trade. For me, I could care less. If there's early exercise, which is still rare, even with an X date, that means I've maxed out my trade and I have the cash back to then reinvest. So I don't care. If you do, then you would not execute this trade because of that 5/9 ex-dividend date. Now, the approximate current at the money implied volatility is 25.4%, just slightly more than that of the S&P 500. Okay, and also the earnings date is 8/1, so that doesn't interfere with this particular contract. Let's now calculate my initial calculations, which was from Monday. At the time, Howmet was trading at 154.84. I sold the out of the money, again, aggressive when you use out of the money for covered calls, 160 strike and generated $1.72. And this was for 200 shares or 2 contracts. Now, the calculator tells us that this is a 12-day trade if taken through expiration with a break-even price point of 153.12. Now, the brown cells are the meat and potatoes of the initial calculations. Tells us that the initial time value return, 12 days, is 1.11%, which annualizes out to 33.79%. But since we use an out of the money call strike, there's an opportunity for another 3.33%, as you can see in the purple cell. So here there's an opportunity for about a 4.5% 12-day return if this stock moves up to or beyond that out of the money 160 strike. Now here's a screenshot showing my broker confirmation of these trades. Number one, where I purchased 200 shares at 154.84 and then sold 2 contracts of the 160 strike expiring on 5/16 for $1.72 or 172 per contract. I also put in my 10% buy to close, good till cancel limit order in case the price of Howmet decline. okay? And that was set at 17 cents or 10% of $1.72. Okay, that's all part of our exit strategy arsenal. Now, I generated $344 less some very minuscule trade commissions, almost not worth mentioning, usually between 50 and 65 cents per contract. The cost basis was $30,968. That was the cost to buy the 200 shares. Now, the unexercised return, 1.11%, 33.79% annualized, as you saw in the spreadsheet. But now there's an opportunity for another 3.33% over the next 12 days. Well, let me tell you where we are today, 11 a.m. Eastern Time, Thursday, May 8th, as I'm creating this video. Howmet has moved up in value to 157.40, which is $2.56 above the entry price. So if the trade ended today, we have another $512 of profit. It's also $4.28 above the break-even price point of 153.12. Now, does this mean that we are guaranteed a successful trade by expiration day? No. I mean, the price of the stock can go down. We still have our 10% buy to close good until canceled limit order in place to protect us against share price decline. But as of right now, we're doing pretty good. Let's summarize. Significant returns can be generated with a 12-day aggressive covered call trade. Option trades can be crafted to align to all market conditions. Now, I just want to reiterate that right now I'm doing mostly defensive trades, but I am doing a small percent of aggressive ones with very elite performing securities like Howmet. And that's the reason why I chose this one to be one of my few aggressive trades. Folks, that ends this sample trade video. I'll be doing more because the feedback has been amazing. I hope you enjoyed this video. I hope it not only benefits you, but I hope that as time goes along, it'll give you kind of a guideline as to how to craft your trades, not based on my personal risk tolerance, but based on yours. I'm always happy to share with you what I'm doing and why, but I will never tell you what to do because I have way too much respect for you, and I just don't know what your risk tolerance level and goals are. So hopefully this will be beneficial to you. I also want to thank you so much for taking the time to watch this video. Hope you enjoyed it. And ladies and gentlemen, as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.